All right, good morning, everybody. We've got a real busy day today. Looking at what's going on, small caps are up the most. They were leading yesterday too, later in the day, or at least midday. Let's say it that way. S&P up 0.75%. The NASDAQ slightly above, not quite 1%. Hong Kong at a half, and the Dow at a quarter. It's moving in the right direction. This Japan number, it seems like sometimes this website just doesn't do a good job. I went over and was looking at Japan on TradingView, and it's not matching this number. Seems like they've been stuck. It seemed 2 or 3, 4 days now, it was at that -2, and it just wasn't making sense. So that's why we double check, right? That's why we go to multiple sites, look at different things. We can't trust a website like this. I'm signed in, but I don't have, like a paid account on this website. And that's what you get with free. So a little cautionary statement when it comes to these websites. You get what you pay for. It's a free site. So Japan's not down like that. If you go and look at the chart, they're basically flat after a doji day yesterday. And if you remember yesterday, it was showing like a -2 something as well. And I had made a comment that it seems to be multiple days in a row. Nah, nope. So whatever, but it is a busy day today, including we're going to get some job numbers. Now, this isn't the big one. It's not non-farm payrolls, but it goes to the heart of the Fed's mandate, right? That dual mandate between employment, the economy, inflation. Well, they slayed the inflation beast. They said, that solved, no more problem there. And they moved on to focusing on jobs. So we need to focus on jobs. Any data, any relevance to jobs at all, want to pay particular attention to that. We also have a lot of Fed speakers today, and we have the president speaking today twice, it looked like, right? So we got one at 2 o'clock, and we have another one at 9 o'clock. Like I've mentioned before, he can not show up late. They can end up just putting out a statement rather than him actually having a speech. And then there's a difference between having a speech and doing Q&A or not. So might want to dig into that a little bit more. We're going to get a lot of data out of Japan, and that's where some of our risk is now that we're done with NVIDIA. The market didn't crash and burn. They seem content with the idea that there are really expensive chips that only the most cash cows can use, like the Mag 7 group, and that those cash cows are still buying these really expensive chips. When you're selling chips for $30,000 a piece, you don't have a very large client pool, but the pool that you have, as long as they're still buying, you're still in the runnings. They haven't yet found a way to diversify their client base with not with those chips anyways. So we're done with NVIDIA. Japan is the next big deal, at least from where I'm sitting. Get through the job numbers, get through anything with the Fed today. And then, of course, as we get closer to mid-March, we've got an issue with funding in the government. There's a little bit of a whisper going around that having a government shutdown wouldn't necessarily be a bad thing from the position of the sitting president when they're trying to find ways to reduce the size of government in the first place. So what it will look like if they deliberately force a government shutdown. Don't know what the markets are going to think about that, yeah? So we've started to turn around with the idea that, okay, NVIDIA is done, AI is still strong, the demand is still there. What we want to keep an eye on now is that we keep the Goldilocks position of the dollar and the 10-year. Sure, we're expecting to see them go up a little bit, but we don't want them climbing back up like the dollar back above 107, the 10-year back above 4.4. That'd be a good starting point of a line in the sand that we don't want crossed. We're still inside yesterday's range. Yesterday, we hit our head on the ADR half and stalled out. Left a lot of trash up there, or a lot of structure. It's going to be a lot of work to get through that, but we got to get through the cog line first, 60.11, before we can challenge yesterday's high and maybe get that breakout. We got the 0 gamma up there, 60.24. Then we've got the 10-week, the 3-week. There's a lot of stuff overhead, right? But the idea would be, if we look at it on the daily, we're just working in this range that we've now turned the corner off this low, and we're going to work our way back up. Some issues with that will be the midpoint, 60.45. That's close enough to 60.50 that I'd rather focus on 60.50, right? If you don't count the expansion below the box and just move this up, then we're at 60.56. And again, I'd rather focus on 60.50, not an overshoot of that. You're a desk hog. My cat wants to lay on my desk and my keyboard, and So the range has been defined from earlier in February. All we did is validate it. We're looking to come back up off of the low now, work through the half, the mid, and get back to the top. This market does not owe us a breakout of the top, but we are looking to get back up into the top area, 61.50. And obviously, we're not looking to do that in one day. We do have the volatility trigger at that 60.50 level. If we can get through that, we'll continue to work our way up. We take a look at last week's range. This is a weekly chart that we're looking at here on the right. 6,100 is going to be the level we want to focus on once we get through 60.50. Right? Those are big, simple, round numbers, whole numbers. Focus on those: 60.50, 6,100, and then 61.50. I mentioned yesterday that we had tagged on the ADR. I turned on this other ADR indicator so we can see the previous days. This is an example of why we want to keep track of it. And when we overshoot it, like we did on Tuesday, that we still have the full ADR that we want to use. So as you can see, they're useful. They provide insight. And when we do break down below them, it shows us and reminds us and tells us, hey, we're moving far beyond what we were expected to do on an average daily range. Right? We're doing something unusual today that is exceeding the norm. So we're almost there, and we still got half a day left, right? A little less than a half a day. And if we get to the red line early enough in the day, we can go to the other side by the end of the day. Now, I know that's not what anybody wants to hear, because going to the other side means we're going to the downside. But there's a lot of Fed speakers today. There's the president speaking twice. We've got some job numbers this morning. There's a lot of data coming in. Any one of those points could flip this over and send us down to 59.44. And it wouldn't make us a bearish market to do that. We've been holding in this range for a while now. We can see 3 days of this sideways activity. So if it did send us back down to the bottom of the range, all we're doing is just building this base out more. It doesn't turn us into a negative market. Now, it doesn't owe us that. We don't have to go down. We can get to the edge, break through that, and continue to expand to the upside. That would give us an inside day breakout. Then we target the full ADR. And if we get through that and we continue to go, one tip will be to look at the SPX if you're an ES trader. The reason for that is these ADR lines, when we look at them on the ES, they are derived by what happened in the overnight. But the SPX doesn't move in the overnight. There's no charting for it. So when it opens at 9:30, it will get lines that are marked from its 9:30 position. So if the SPX opens gapped up, if the ES, for an example, runs up all night in the Globex and it opens high, then the SPX opens high, but it will open high and still be sitting in the middle of these two red lines. So it will then begin running. The ES could already be at one line. It could be at both lines. Then we open into the regular market. The SPX gets to start running, and the ES can move in the same direction until the SPX hits a line. We didn't really have a gap yesterday to see that play out. If we were going to see an example of it, maybe this one would be a gap enough to kind of get that point across. But that's the idea, right? That the SPX can open gapped up, but the ADR will be centered on wherever it does open. So it has room to run to its ADR line. If we overshoot that and we continue to go, then you can measure the distance between the two ADRs and you can begin to plot those out. That's extreme though. We get that extreme. You should see it in everything. You should have like a 98% advanced decline, ticks running in the 800s, strong flows. We got a narrower channel than yesterday. A narrow channel implies we can continue to run if we do get a breakout. This kind of argues against the idea that we're going to reject off of the ADR and fall back down. This implies we're going to break through that ADR and continue to move. And that if we break yesterday's high, then we can just keep on going. Just keep in mind that this channel doesn't make price do anything. It's not going to make us break out. It won't make us run if we do break out. It's just giving us insight on what to expect if we do break out. The channel today is higher than yesterday. That's bullish. Price opened above it, and that is bullish. We didn't keep it, though. You can see we dumped right back down. We had to climb our way back up. But we know we opened above it because it's not red like this one back here where we opened underneath it. So whether it's just a fluke of the way that this thing printed out or not, doesn't really matter in the grand scheme of things. Here's the 6 o'clock candle, and it shows that we're underneath it, but it was counting all this other stuff. Either way, it's Thinkorswim's code. Sometimes it's not perfect. This looks like it probably should have been red, you know, all things considered. At 6 o'clock, we were underneath it. But we're above it now, so it's not an MDP, missed daily pivot. We've hit it. We've passed through it. Any move to the downside now needs to stay above this. Otherwise, we'll focus on yesterday's low, right? That's a nice, clean 30-point target. All we got to do is get through the floor pivot. So now we've got a plus and a minus in both directions. We've got tradable opportunity. All we got to do is get there and begin to expand. So with that in mind, one of my favorite trades is yesterday's 111. I talk about this one all the time. And it's playing the reversal where we break out of the previous day's range. We look to flip right around that 111. Maybe it overshoots into the 1236. All of this today is telling us don't try to trade that reversal. Now, me, I'm stuck in my ways. I'm probably going to try to trade that reversal. But if or when it fails and we continue to move, then just take the loss and flip the trade and run it in the other direction. We are still underneath the floor pivot for the week. If we continue to move to the upside, 60.73 is going to be the target, but that's a big ask for today. I really don't see it on the table today unless the news gets really excited, right? Like it would take some real juice to push us all the way up there. The overnight volume today is much like the overnight volume of yesterday, so we still have participation. They're not sitting out hedging. They're, embracing what we have and trading into it. We want to do the same. On the week, we really still don't have anything of note other than a classic distribution. I mean, it really doesn't get much better than that. You couldn't ask for a more textbook perfect example of classic distribution. Doesn't provide much insight other than we're above the point of control. So 6,000, big round number. We expect structure to be there already, and this implies that it's where we had the greatest amount of trading volume take place this week. $10-day, 30-minute volume profile with TPO. It's likely in the stream that you can't see the green bars here, but the point of control on both of these profiles is up at 61.33, and we haven't got to those candles yet, so we haven't begun to remove that volume. But none of the other volume anywhere else in the other 10 days comes close to matching what we have up there. And that's because we spent a lot of time up there, right? From Friday to Friday, a whole week just sitting up there in that one spot chopping. So to match that or to challenge it, we have to find some new spot and sit there and chop and build out volume, or we just have to eliminate these candles, one or the other. So, whichever comes first, we'll be looking to see that move. It's always nice when we can add "and" to things, right? The 111 from yesterday is also the daily option range. So, we say it's the 111 and it's the daily option range and it's a measured move and I believe it's a point of control measure. Nope. I was thinking there was it's a VPOC measure, maybe that 60.33, right? Maybe. Because it's a cog line too, isn't it? No, not quite a cog line. Close. How about that? It is a cog line and it's a VPOC line. Just keep adding those words "and" to it over and over. It's the 111 and it's a cog line and it's the daily options range and it's a VPOC. Yeah, you like it. For today, we do have a new VPOC. Seems like we're hitting it. It's very likely that we'll be done with this one before the morning, even for the morning bell. But let's get it lined up in there. I've quit using ticks on these. I just use whole numbers. So I'm going to set it at 14 and we hit it. So it's no longer a VPOC, but I'm going to keep that line today. I'm just going to change its line type, change its name. The textbooks will tell you to carry these lines forward every day. And normally I don't, unless it's a VPOC, I don't bother. I've got enough pivots. But there are times where I keep one through the day, and it's just a regular pivot, not a VPOC. That's what I'm going to do today. Just keeping my eye on that spot. It's 60.14. Really, it's close enough to 60.11 that it's the cog line, and that's good enough. We don't need that line. I'm just going to go ahead and keep it on there anyways. For today, it won't be a keeper. So the range on the week held. We've been holding above it, but we haven't got back to Friday's close yet. That's another line in the sand we really want to get through. Get back inside the previous week's range and get back inside of Friday's close, which was really close to the low of the day. It wasn't the lowest of the day, but pretty close. That's at 60.29. It's close enough to 60.32 cog line. We are still below the 10-week. That's another line in the sand we have to get through, and we have to get away from it. If we're around that 10-week, then it's like gravity. It can just hold us there. We have muted range, muted trading, suppressed volume, suppressed volatility. We need to expand away from that 10-week. But first, we have to get above it. Same with the 10-day. We're on our way back up. First, we got to get there, get through it. A 0.5% above would be a good start, but then we need to get beyond that. You can see we've had a hard time getting beyond that 1.5. Now, we've tried to tickle that a little bit, expanded just a little beyond, but we just couldn't quite get there. Let's get past that 1%, and then we can keep it, but we have to get there. One thing at a time, get through zero, get through a 0.5% to the upside above the 10-day. All right, if we're looking for a capital rotation, then we're going to be looking for growth versus value changes, staples down, healthcare back down, consumer discretionary technology back to the upside. It seemed like we were going to go ahead and take out that 200 period moving average on both of these, consumer discretionary and technology, but we didn't. We started to run back up without it. I think I'd rather have hit it, just get it done and have some structure on this bounce. So sure, we could run back up now. We did it before back here without hitting the 2. We just, we found structure and ran back up. I'd like it better if we just go ahead and get it done. But it didn't ask my opinion. Rude. So we started to turn the corner yesterday. Let's finish that out, continue to work to the upside. Same thing with consumer discretionary. We've stabilized there. Now we need to turn it around and start working our way back up. If we're going to get that capital rotation, then it should start to show up, right? And we want to see those changes reflected in the names that are up in the pre-market and then the names that are leading us through the day today. Oh, I broke it. Come on, Thinkorswim. So things that are down this morning, the VIX, 6.5% move to the downside. The inverse Mag 7 or the negative Mag 7 is down. I know that's kind of like a double negative. The Mag 7 is up. So when we see FNGD, which is the FANG's down volume, when it's down, then the up volume is up. We're getting a lot of positive volume in the Mag 7. Gold is down, precious metals, bonds also down. So when we flip things over, there's the up volume on the Mag 7. We got Bitcoin, so risk assets back in play. There's the Mag 7 collectively also up. Uranium, China, chips, growth, tech, China again, tech again, consumer discretionary, software also up, biotech, China again, financials. That's what we need, right? Cloud computing. We've got everything we need for a breakout rally day. We've got financials, communications, consumer discretionary, chips, software, cloud services, technology, China, and Bitcoin. That's everything that we need for a breakout rally day. So as I covered, watch the clock, keep your eye on the news, watch that ADR line. If we cut through it, I think we just keep going. Be careful, be safe. I'll see y'all tomorrow.